British Columbia, Nova Scotia, Ontario, and New Brunswick saw the biggest increases in insolvencies over year at 32.5%, 27.4%, 23.9%, and 15.6%. Hey guys, Alex Lay here from Try and True Mortgages, just with another Try and True Mortgage Academy. I'm going to go through a quick Financial Post article talking about Canadian household debt, some things I want you to see in there, and I think it's important to look at right now, especially where the position we're in with high interest rates, debt levels potentially increasing, and potentially a recession in the future, which I'll show some data for in the video. If you guys don't know who I am, my name is Alex Late. I'm a mortgage agent with Try and True Mortgages in Hamilton, Ontario, Canada. We help Canadians with home financing, refinancing, equity takeout, and debt consolidation. So if you need any of those services in the Hamilton area or surrounding areas, let us know. Thanks. Okay, so this is the article I was just referring to. It's from the Financial Post. The Financial Post has some good information from time to time. Some of their articles can sometimes be misleading, but I do think this one has just some good general information that I think is good to bring up at this time. So it says, post-haste signs that Canadians are struggling with their debt load are rising. Insolvencies haven't been this high since the start of the pandemic. Alrighty, we'll just start with the article. Signs are beginning to appear that the debt problems in Canada are on the rise. The number of Canadian insolvencies in November hit a high not seen since March 2020, a month of widespread lockdowns at the beginning of the pandemic. This is really interesting because, as you'll see in a chart I'm going to be showing later, the debt levels in Canada were actually rising steadily up until 2020 March, when the pandemic hit, and the interest rates came down. Government started giving out free money, and everyone really just stopped spending. So it's interesting that we're actually sort of back to that March time, because it's almost as if we were going to have some economic uncertainty at that time, and the pandemic in a way actually just sort of saved it. Not the pandemic, but the reaction to the pandemic. So the governments, specifically the Federal Reserve and the Bank of Canada, reducing interest rates, it really took the load off Canadians, and they were able to sort of start saving up again, which we'll see in the charts later on. There were 9,784 insolvencies filings in November, the highest number in 32 months, and a 17.5% higher than a year ago, and we're 17.5% higher than a year ago, according to the numbers released by the Office of the Superintendent of Bankruptcy. So if you guys don't know, Office of the Superintendent of Bankruptcy, obviously a Canadian institution that tracks this. This is the first time we have seen the numbers close to pre-pandemic levels, said Michelle Stats, a licensed insolvency trustee at Bromwich and Smith. Soaring inflation and rising interest rates have taken a toll on household finances, and now the strain is starting to show up in the numbers. Charles St. Arnaud, chief economist at Alberta Central, said in a note that November's increase was the first after 2 straight months of decline, suggesting that the rising trend seen in the spring of 2022 could be returning. So this just means, we had seen a trend in 2020, and then it sort of declined, according to what Charles said, and now we could start seeing that increase again. Insolvencies, which include bankruptcies and proposals, a renegotiation of terms with creditors, climbed 4.7% in November from the month before. Despite November's increase, insolvencies still remain below pre-pandemic levels. However, proposals are sharply up over the past year and are now above their pre-pandemic levels in BC, Alberta, Saskatchewan, and Manitoba. So an insolvency is different than a proposal. Obviously, insolvency technically just means that you have become insolvent, so you can't afford to pay off your debts with the amount of money that you are bringing in on a monthly basis. A proposal is when, let's say I have $10,000 worth of debt, and I can't really make those payments, you can start a consumer proposal. The proposal company or the trust company or whoever you deal with will go to all of your debtors. In other words, credit card company, line of credit company, mortgage company, and they will try to negotiate with them a term of how to pay out those debts. So let's say your payment was, I don't know, $1,000, just to be exaggerative, $1,000 a month. They'll try to negotiate a term maybe that you can pay $650 a month. It doesn't mean that your credit score won't be hurt. Your credit scores will be destroyed for at least two years, but you'll at least be able to live and pay those debts down without having the stress of not being able to pay at all and going into full bankruptcy, which is a lot worse. Despite November's increase, insolvencies still remain below pre-pandemic levels. Oh, sorry, I just read that. This situation suggests a rise in households struggling with their debt load. British Columbia, Nova Scotia, Ontario, and New Brunswick saw the biggest increases in insolvencies over year at 32.5%, 27.4%, 23.9%, and 15.6% relatively. So this is pretty big. I mean, to have it, at least in British Columbia, just use that alone, 32.5% increase in insolvencies, that's a huge number. I mean, could see it reasonably be, increasing 5% or 10% over a year, but 32%, wow. According to the CIBC's annual financial priorities poll, a quarter of Canadians said they took on more debt in 2022. Among the top reasons were the increased cost of living, expenses exceeding income, and the higher cost of borrowing. So this is data is different than polls. So I mean, a lot of Canadians, it says a quarter of Canadians, so 25% of Canadians took on more debt in 2022 because of cost of living, et cetera, et cetera. But you have to sort of take that with a grain of salt because it says a poll. People could have made up the numbers, could have lied, could have over exaggerated, might not even know and just say a number. So if it was data and you could see the finite numbers, then we could trust that more. So I'm not too big on the quarter amount. Let's say even half are true, still means about 12.5% of Canadians took on more debt in 2022. So that's even a big number right there. But we'd have to see what that relative is, how high that is relative to other years. St. Arnaud says insolvencies are likely to rise in coming months as record levels of household debt, declining purchasing power because of decades high inflation, and a steep rise in interest rates put more pressure on household finances. As the economy slows further, there's likely to be a rise in unemployment, he said, which will push more households into insolvency. So this isn't just true. I mean, this is not a revolutionary statement. As the economy slows, or in other words, as people start spending less, businesses make less money, and then because they make less money, they can't afford to pay their employees, so they start laying off employees. So it's not really revolutionary, but it is true, and it looks like we're going to be going into a recession, which I have some charts showing that later. So yeah, so to be a rise in unemployment, which will push more households into insolvency. So, and then when you have more people unemployed, less people can obviously pay for stuff. The question he says is whether the strength of the labor market with its almost historically low jobless rate and the savings accumulated during the pandemic will continue to provide relief. Unfortunately, Canadians may only have begun to feel the bite of higher borrowing costs, but the Bank of Canada expects to raise its key rate to 4.5% this month. TD economists predict that the debt service ratio will hit a record high of 16% by the second half of this year, surpassing the pre-pandemic peak of 15%. So, in other words, the debt servicing ratio is how much of your household income. Let's say you make just $100 per month. Let's say $15 of it went to debt. That means you have a 15% debt servicing ratio. So I guess what they're saying here is that the debt service ratio will hit a record high of 16%, surpassing the pre-pandemic peak of 15%. So even being at 15% is really high, which means that $15 of every paycheck you get out of 100, let's say, or 15% of whatever amount of money you're getting is going to debt, which is super high. With interest rates forecast to remain higher at levels over 2023, TD expects much of Canadian pandemic savings will go to paying the higher cost of debt. So this is just true. Over the pandemic, over the years, I guess 3 years now, but from March 2020, we saw savings rates drastically increase because people were staying home, weren't really spending much, although they could buy a home, but online, but it wasn't the same as going to stores, eating out, etc. So we saw, I think it's up to 350 billion in excess savings that Canadians don't normally have, which is great for Canadians. It's just uh, it's probably not a good thing for the economy. So, and that's to put it lightly. So let's just look at if this article is even true. The way I was sort of looking at it, I went to Trading Economics. They have some great data points, and I wanted to compare Canadian household credit market debt to disposable income. So disposable income is just your income that is left over, or net income, I should say, left over after you pay off all mandatory expenses. So your mortgage, your rent, food, transportation, those are mandatory things. And then the excess would be disposable. And then let's compare that to the Canada household savings rate. So household savings rate is on the right hand side. It shows us a percentage. So how much are they saving, as opposed to how much of their disposable income are they saving, and then the household debt in Canada is also a is a nominal number. So this is really interesting. What you can see here, we'll look just at 2020. You can see from 2016 up until 2020, we were pretty much steadily rising in terms of the household credit. And then in 2020, the pandemic happened, and March 2020, they lowered interest rates, and that household credit essentially just plummeted. And at the exact same time, the household savings rate, because people weren't going out, they weren't eating at restaurants, they weren't going on vacation, skyrocketed the other way. So you can see a direct inverse almost correlation. It's not perfectly one, but pretty significant here that you see this savings rate go up and the debt rate come down. And then you can see all the way through basically 2021 remain low, reduce a little bit, but then again, as soon as interest rates started rising again, we started to see the household credit start to increase and the household savings start to decrease. And we've pretty much seen the household savings decrease significantly from where it was in 2020 there, which was probably just an anomaly because of the free money that was being given out as well. But this, in other words, this chart and these data points are actually proving what the Financial Post was saying. First, they said that they mentioned a little bit about the pre-pandemic levels. We did see household debts increase quite a bit, and then we saw them fall, and so household savings increased. But they're saying now that they're starting to see those pre-pandemic levels again, which, if we were to draw a line here, you can see we're already past the household credit and have money even much higher. So that's not a really good sign. The only probably positive outlook here is that the household savings rate is still higher than where it was in 2020 when we had those higher insolvencies and so on that they were chatting about in the article. So once this black line here, this Canada household savings rate decreases, I would say below even these levels here, 2020, 2018, then we'll be in a really, really big problem because we have less savings and we have higher household credit. So just in other words, you have more debt you need to pay off and you have less money to use to pay off those debt. So it can really only lead in one direction. So what can we expect in terms of, should we expect this blue number here or this blue line, the household credit, to decrease? Well, it really all depends. One of the major credit, one of the major causes, I guess you would say, of interest is what the 5-year bond yields are doing. So that affects mortgage rates, but the mortgage rates are just following what the Bank of Canada is doing. So if we go look at the 5-year government bond yield, we can see, we put this to 1 year, right? Let's even go to 3-year. You can see, first off, we were historically low up until 2020, all the way through 2020 because they lowered the rates. We've steadily been increasing since then, and we're just sort of bobbing up and down in 2022 here, which is why you've seen interest rates, specifically for mortgages, go from 1.5% to 6.5%. So right now we're at a 3.01, and it doesn't look like it's really trending down. It just looks like it's trending sideways. So we could probably expect this Canada household credit market, or the Canada household debts, to continue either to flatline across or continue to increase. Meanwhile, the household savings rate will come down, which just sort of points towards a recession. And like the article said, unemployment leads to more insolvencies, more consumer proposals, bankruptcies, etc. So that was all good information, and I think it really provides us a good outlook as what we've seen and where we think we should be, where we think it could be going. All signs sort of indicate that the blue line is going to continue to go up. The black line is going to continue to decrease, which would mean we're going to be going into a recession. And just to top that off, I have another chart here from a gentleman on Twitter. His name is Macro Elf. I guess he used to be a investment fund manager. It has some really good data that he puts out. And so I'm just going to read his tweet here for you. This is about the United States, but just remember, when the United States sneezes, Canada gets sick. So we really follow in line with what's happening there. So he says, new lows for the U.S. leading indicator index. This indicator has a 100% hit rate on anticipating recession with a 7 to 8 month lag. It's now pointing to a recession starting in Q2. That would be March, April, May, June, sometime in that area, and on par with the 2001 recession. Markets, in the meantime, soft landing and la la land. So he's just talking about the stock market there, but I'm not going to mention that too much. But if you can see on this chart, what's really interesting is, like he said in his comments, this is where we are right now. We're not actually in the recession yet. So in 2020, this was our recession. It wasn't really a recession, but that's what you can technically call it. We're not even in the recession, and we're pretty much where we were in 2020. So what he's saying is we should be expecting a 2001 level type of recession, which would be just somewhere around here. Okay. Hopefully we don't go down to the 2008 level, but you never know, anything can happen. And then he's saying 7 to 8 months once that decreases. So yeah, it's sort of pointing out what everybody intuitively knows, but it's good to see some actual data. And this thing has a 100% hit rate. It's just data. It doesn't lie, right? It just suggests things. So guys, if you like this video, or I guess to wrap it all up, prepare for recession coming up. How long it'll be, I don't know, but I do know that it doesn't seem like it's going to be as bad as something like a 2008, because Canadians are still pretty strong with their savings unless that really steeply declines, or we have some sort of huge issue in the housing market, which it could happen just if interest rates stay this high. Remember, if we go into a recession like this chart is indicating, like everyone else is indicating, interest rates are going to come down. So I don't expect that huge housing bubble crash. We've already seen quite a correction just from February until now of 2022. But so if we see that recession and interest rates come down, the housing market should level off and potentially even start to increase. Alrighty, but guys, yeah, if you like this video, again, my name is Alex Slate with Try and True Mortgages. We help Canadians with home financing, refinancing, equity takeouts, and debt consolidations. If you guys have any questions, comments, feel free to leave them in the comment section. I'd love to hear from you guys, your thoughts. Am I right? Am I wrong? And go from there. Please subscribe, like, and we'll talk to you soon. Cheers.